All right, again, my name is David Kinsey. Thank you all for attending today's presentation on successful cross-border investment management and financial planning for foreigners and cross-border families in the United States. We are going to walk through a series of slides discussing the issues at hand this afternoon, and then we're going to open it up to questions from the audience. Please feel free to type your questions into the chat session, or at the end I will unmute everyone and you'll have an opportunity to just speak your questions. We're going to get going here in just a few moments, but I want to say again thank you all for attending. Please feel free, if you're not able to stay through the whole presentation, to contact us later with specific questions. There will be a recorded version of this as well available if you would like to get a copy of it. It'll be posted on YouTube by the end of the day. And finally, I will just simply add that we do these types of presentations on a variety of related investment management and financial planning issues on a frequent basis, and we would love to have you join future presentations or contact us about your specific questions, and always feel free to invite others who you would think would be interested in these presentations if you are on our mailing list and would like to disseminate that. But let's get to the issues at hand today, which I know that you've all come here for, and I'm going to dig right into the presentation, and then, as I said, we will open it up for the question and answer session at the end. All right. So the presentation starts with an introduction about Thun Financial Advisors, and then we go on to talking about the challenge of cross-border financial planning. Then we move on and talk more about what Thun Financial does in terms of helping our clients, be they foreigners in America or cross-border families or people outside the United States, deal with the complex cross-border planning issues that we talk about in the previous section, how we help them navigate those to achieve efficient and strategic, positive, long-term investment outcomes. And then finally, we come back at the end of the presentation and talk a little bit more about the logistics of working with Thun Financial Advisors as your investment manager. So a little more background on our firm for those of you who are not real familiar with Thun Financial Advisors. We are an investment management and financial planning firm. We provide comprehensive approaches to building long-term wealth designed specifically for the needs of expatriates in the United States and outside the United States. Not surprisingly, our client base is very global. Approximately 80% of our clientele reside outside of the United States. And very importantly, we are organized as a fee-only registered investment advisor. I'm going to take just a minute to describe exactly what that means, because it's a very important aspect of how we deliver superior service and superior long-term investment outcomes to our clients. The fact that we are fee-only means that the only source of revenue that our firm, Thun Financial Advisors, receives are the fees paid to us by our clients. So we don't make money from outside providers such as a custodian, Charles Schwab, or fund companies whose funds we may recommend. We don't get a big commission if we can talk you into an insurance product. Okay, those are the traditional ways by which investment advisors and brokers and investment managers are paid. The problem with that is that it creates all kinds of conflicts of interest. We don't want you to ever be concerned that we're making a recommendation on an investment to you because we're going to make more money if you buy for this kind of investment versus that kind of investment. And the way our fees are structured, we don't. We only are paid by our clients based upon the amount of assets they have in management with us, and we'll discuss that at the end. But this way, you can always be sure that the client knows what they're paying, how much they're paying, and to whom they're paying it. It's transparent, it's efficient, and it aligns our interests with our clients. And that helps us, in a very important way, deliver excellent service to our clients. Our team here at Thun Financial Advisors is made up of 4 primary advisors who you see in front of us. We all have experience not only from the point of view of investing and planning with relevant experience in investment expertise, accounting and law and so forth, but we have all lived the lives of our clients. We are all foreigners in America. We are all Americans who have lived as Americans abroad. We have cross-border families and cross-border investments and interests. So we understand the world in which our clients operate, and that helps us provide excellent service. Furthermore, I would add that we work as a team. when you work with Thun Financial Advisors, you access all of the investment personnel, as well as the support staff that you don't see here in terms of providing you with superior service and gaining access to their particular expertise. All right, now let's dig into the heart of the issues that we want to address today. In this section, we're going to begin by talking about the cross-border investment challenge. And I'm going to talk initially by setting the stage by focusing on a couple of critical issues. The first one is to divide essentially the world into two groups, okay? Those are U.S. citizens and green card holders as one group, and then non-resident aliens as another group. And I want to talk about U.S. citizens and green card holders because for U.S. tax purposes, they are taxed the same way. Right? Once you become a green card holder or a permanent resident of the United States, you are for all intents and purposes taxed just as a U.S. citizen would be. And furthermore, okay, that means you are taxed on your worldwide income. No matter where you go, okay, whether you're in the United States or outside the United States, you will be subject permanently to U.S. taxation on all of your income sources. Now, we often work with non-resident aliens because they're family members or because they've come to us for investment advice. Non-resident aliens are essentially non-Americans living outside the United States, a foreigner outside of the United States. Now, they, for the most part, are not subject to U.S. taxation, except potentially on U.S. assets that they may own within the United States. But in general, they are not subject to this regime. However, when we work with many, many families, we find that the families themselves are a mix of U.S. persons, that is green card holders or citizens, and non-resident aliens. And this creates a complex intra-family tax and planning and investing environment that has to be managed effectively to achieve successful long-term outcomes. And then finally, the second point in this introductory remark that I want to make is to remind all of you that the U.S. employs what is known as citizenship-based taxation. And when we say citizen, we also mean permanent residents, green card holders. And that is the unique regime in the United States.
Yeah, you just heard.
Okay. We apparently have some audio problems. We are facing some audio problems here.
Good.
Okay, it's back on. I'm sorry about that. We were just informed that we had lost our audio, but apparently it's back on. Sorry about that. Let's continue here. Okay, so yes, citizenship-based taxation is imposed on the basis of being a U.S. citizen, and it will stay with you even after you leave the United States if you have become a permanent resident or a citizen while you're staying. These two issues will inform much of the discussion we are going to have as we talk about the complexity of cross-border investment and financial planning. Now, the other key base assumption that we need to discuss in this presentation is the idea of FATCA. What is FATCA? Uncle Sam sees all. FATCA is a big law that was passed in 2010, and as a result of FATCA, it allows the United States government, because of a series of agreements with foreign financial institutions as well as foreign governments, to see assets and income that are owned and received by U.S. persons, that is U.S. citizens and green card holders, wherever it is in the world, right? So for the first time ever, as a result of FATCA, Uncle Sam has great transparency on seeing all the sources of income anyone who is a U.S. taxable person may have, whether it's inside or, critically now, outside of the United States. That means a whole series of tax obligations that heretofore were frequently not fully reported or misreported, it wasn't understood by U.S. taxable persons that these assets and these income items even had to be reported, will now have to be reported, because you will have to assume that the IRS has full transparency and knows what your income outside the United States is, as easily as they do what income you have inside the United States. And this fundamentally changes the game when we think about how we have to plan across borders on our investment and financial planning strategies and goals. Okay, with that, I'm going to turn it over to my colleague, Frederick Behrens, who's going to talk about U.S. taxation of non-U.S. assets.
Hello. Yes, as David mentioned, there's nothing illegal about owning a, foreign investment account, a foreign mutual fund, and the problem is really coming down to reporting. Probably one of the biggest kind of issues we see when working with Americans abroad and foreign nationals in the United States is the ownership of foreign mutual funds, foreign life insurance products, and other pooled investment products. These are not treated by the U.S. Government as a normal mutual fund, as one you could buy here. Instead, the IRS consider these passive foreign investment companies, and these are a tax nightmare and can be really punitively taxed if owned by a U.S. taxpayer. As David mentioned, the new FATCA law, ensures that the IRS is eventually going to find out about these foreign financial assets. For example, if you had a foreign mutual fund, whatever you were doing in the past, maybe you were just treating it as a U.S. mutual fund or doing something else or just ignoring the problem, will not work anymore. When when FATCA is in full effect in several years, the U.S. government's going to be provided with this information, and presumably will start to enforce these rules. We also see a lot of foreign retirement accounts that are in the same way. Maybe you have one from 10 or 15 years ago of working in a foreign country, a foreign government pension, and you continue to hold it while being a U.S. taxpayer in the United States. These assets, kind of according to the tax law, require ongoing reporting. Maybe in the past you were just kind of ignoring the issue, waiting till you retired and began taking withdrawals to start dealing with this. But going forward, the IRS is again going to have a window onto these assets, and will start asking questions about, have you paid taxes on the funds within these accounts? What are you doing with the gain? And ultimately, how are you paying taxes when you make withdrawals in retirement? Again, another type of asset we see beyond the retirement accounts, a bit more unique, are foreign business ventures. These would be any type of partnership, corporation, a joint venture company that you have a share in abroad. Even if the company's not making money or it's just starting, there are informational kind of reporting requirements that even though you won't owe any taxes, you might be making a loss. You still need to file these forms with the IRS, and they can come in later when the company is making money, when you're trying to sell the company or do anything else with the company, and you must pay the by failing to file these forms previously, the IRS is going to impose penalties and fines, and ultimately it's going to be another tax headache to have. We also see issues with foreign real estate. Again, you don't have to report these assets every year to the IRS. You don't need to report foreign real estate holdings on the FBAR or Form 8938. But any capital gains from a sale or any rental income, this must be reported to the IRS in a similar fashion if you own the asset, back home here in America. All these assets are fully taxable under U.S. law. And the IRS with FATCA is starting to really investigate transactions into bank accounts and such that may imply ownership of foreign real estate and the proceeds from it. Moving forward, what will happen? We talked about foreign assets while in the U.S., but what about leaving U.S. assets in the United States if you decide to leave the United States for retirement, for another job? What happens if you give up your green card and such? And generally, one of the big mistakes we see is as a person's first reaction is to cash out U.S. retirement accounts immediately when they decide to leave the United States. And we see this having, in most cases, having kind of extreme tax consequences. If you're, if you're not 59 and a half yet, you'll pay a 10% penalty sometimes, and also you're going to be taxed at full ordinary income tax rates on the account value. So if you decide to withdraw all of your IRA or all of your 401k, you're going to be paying a very high income tax rate. In most cases, it's usually much more efficient to hold on to these assets. There's nothing that says you have to cash them out when you leave the United States, and have tax efficient managed withdrawals over over the life of the account and then through your retirement to minimize the amount of U.S. taxes that are going to be owed. And furthermore, one more reason we really like to keep retirement accounts in the United States are the really good investment options, which David will discuss more in the future. But having access to these U.S. accounts provides greater access to low-cost mutual funds and ETFs, more liquidity, and generally lower costs than investing outside of U.S. financial institutions. And now at this point, I'd like to pass on the presentation to my colleague Stan Farmer, who will discuss some estate planning issues.
Okay, thank you, Fred. As Fred indicated, my name is Stan Farmer. I'm going to briefly talk about certain estate tax issues before handing this back over to David, where we're going to talk more specifically about how we help clients navigate this difficult cross-border environment with the investment management. Okay, we'll start here with just a brief discussion about the U.S. estate tax. Okay, it is in a similar way to the United States income tax. It divides the world into two groups: the U.S. Citizen and permanent resident, and then non-resident, non-citizen individuals that may have property that would be subject to the U.S. estate tax. Okay, the U.S. estate tax, for 99% of the people that fit into that first group, it's not a particular concern because of the high exemption level, that $5.43 million threshold. And basically this means that if when you die, you have a taxable estate in your global assets, because you're subject to worldwide taxation on your assets with estate tax, just like income tax. But if you die with wealth below that threshold, you're not going to owe any estate tax. If you die with wealth above that threshold, then you may owe estate tax. It's going to depend on whether or not you took steps to keep that outside of your taxable estate or not, and keep your taxable estate below that threshold. So think of that as the level where sophisticated estate planning takes on a certain degree of importance. And we're spending a little time with this today, in particular for those non-resident, non-citizen folks that may be in attendance, because this is a particular area where non-resident aliens are particularly vulnerable to U.S. taxation because of the extremely low exemption level that applies to these folks. The U.S. estate tax exemption for citizens and green card holders has gone up in the last decade from $1 million to $5.43 million. At the same time, the exemption for non-resident aliens has remained at $60,000. In fact, it's been at $60,000 for the better part of 3 decades. So it is important to understand that if you are a non-resident alien, you may yet be subject to U.S. estate tax on what are known as U.S. citizen assets. U.S. citizen assets include all of your U.S. real estate holdings, all of your U.S. business property or business interests in the United States, stock in U.S. companies, regardless of where you hold those certificates of ownership, and your U.S. retirement accounts that Fred talked about. So while we believe that you need to create a distribution plan that does not involve you paying early penalty and excessive tax in any given year, you definitely want to monitor the size of that account as you grow older, because it will be a U.S. citizen asset subject to estate tax. Okay. However, I want to stress here that you can directly own a lot of investment assets here in the United States that are not subject to U.S. estate tax. Stock in non-U.S. companies, even held in a U.S. brokerage, are not subject to United States estate tax. Okay? And an even bigger exemption applies to publicly traded fixed income, or bonds, if you will. Whether it's government bonds or corporate bonds, or whether it is our U.S. bonds or their foreign bonds, all publicly traded bonds are not considered to be U.S. assets, and you will not incur estate tax liability on those assets. Okay? So, we talked earlier about the need for complicated estate planning. Obviously, estate planning covers the whole gamut of the way that we pass wealth on from one generation to the next. It includes topics such as wills, trusts, the way we title our property, the way we structure ownership in our own personal wealth or our business interests, premarital agreements, all kinds of things. Each of these things that we do in the realm of estate planning are very legal and therefore jurisdictionally specific, okay? So even state to state within the United States, the rules on how we set these structures up can vary quite a bit. When you're talking about the global, the whole world, many jurisdictions have rules regarding all of these estate planning matters that are completely different from what you have in the U.S. So we have found with our expat U.S. citizens that live abroad clients that they have to be particularly careful when they take up residency in a foreign country, that they understand that the estate planning that their attorney here in the United States may have done for them when they were U.S. residents may create problems for them when they take up residency and domicile in a new country. The estate planning that you have done should always be revisited when you are taking up permanent residency or long-term residency in another country. Okay? Should also keep in mind that these rules regarding situs and what portion of your assets are subject to U.S. estate tax in a mixed nationality or a mixed citizenship family, having different statuses within the family doesn't just necessarily create problems, it also creates certain opportunities. And David will get into that a little bit shortly. Finally, I want to talk more specifically about the reverse of the coin of the person who leaves the United States and takes up residency in a foreign country. Okay, the same notion of auditing or examining your estate planning certainly applies when you take up long-term residency in the United States from outside of the United States. Okay, and a particular area of potential friction or legal confusion can be caused by beneficial ownership in a foreign trust when you become U.S. taxable on your global assets. In other words, when you become a citizen or a green card holder in the United States. A foreign trust is any trust organized in a non-U.S. jurisdiction or controlled by a non-U.S. person. Okay, and the definition of trust in the U.S. is pretty broadly applied. So you may have an ownership interest in a family business or some kind of family holding that is not called a trust. It may be called an endowment. It may just be the family business. It could be a number of things that are not known, that you wouldn't think of as a trust. It may be considered a trust by the IRS here in the United States. And a beneficiary of a foreign trust has very, very onerous reporting requirements in the United States. Okay, so when you become a green card holder or a citizen and you are the beneficiary of a U.S. trust, you may be opening yourself up to an incredibly complex tax reporting environment. And some of the taxes, when you navigate this environment, can be extremely punitive. So this is the type of tax nightmare that can be avoided by taking a look at these ownership things early on, ideally before you acquire residency in the United States. But the earlier the better. These problems tend to become more complex the longer it takes for us to realize there is a problem. We had a client, an American citizen and his Malaysian wife, whose family back in Malaysia had a business that she had a beneficial ownership in, where she was, paid part of the profits from the enterprise. When she became a green card holder and later a U.S. citizen, she had no idea that her ownership interest, such as it was in the family business, was creating a U.S. tax time bomb for her. And unwinding that situation caused a lot of friction in the family. It caused a lot of tax and a lot of machinations for her to essentially divest that trust interest. If it had been caught earlier, it probably would have been no big deal. So think about these things as potential things that you're going to want to get a professional opinion about when you're thinking about changing your immigration status here in the United States, or if you're leaving the United States and taking up permanent residency somewhere else. Your estate plan that is created in one country may not travel well to the next. So now I'm going to turn the presentation back over to David Kinsey, and he'll start talking about some of the solutions on how we help investors navigate this cross-border investment challenge environment. Thank you.
Thank you, Stanton. All right, everyone, thank you for bearing with us. And I'm going to just come back here and make sure everyone is able to hear us before we go on. Looks like no one is reporting any problems, so I presume it's going well. All right, now, in light of what Stanton and Frederick have presented in terms of the complexities of this cross-border environment in which we're trying to build wealth and achieve our financial goals, what are the solutions we can employ if we understand the constraints and opportunities created by this environment in a way to help us build wealth for ourselves and for our family? Well, that's what I'm going to be talking about now over the next couple of slides. And I'm going to begin by talking about the investment imperative. And what I mean by that is when we look at a family's wealth, we see all kinds of different types of assets, including real estate, businesses, investment portfolios. And it's investment portfolios that are probably less common among new Americans, new green card holders, immigrants to the United States, foreigners living in the United States, because it's not as common of a way to build wealth. However, it is a very, very efficient, effective, and relatively low risk way to build wealth, and that's why it's so in the United States, and that's why it's so common here. And I just want to reiterate that point by showing you this chart, which shows long-term average rates of return for common portfolio investments that we talk about portfolio investments. We're talking about stocks and bonds that trade on the stock exchange. We're talking about treasury bills, debt issued by the U.S. government and so forth that make up the common investments of a standard U.S. investment portfolio. Over long periods of time, of course interrupted by periods of declines, but on average they tend to generate a rate of return of about 9.5%, 10%. And this is a basis for a very steady, incremental way that people can make their money work for them. And this is, of course, what we focus on, helping our clients do, build these liquid investment portfolios. And it's especially important to make this point because so many of you come from countries where that's not the norm, it's not the standards, it's not as easily done. But in the United States, it is very effective, it is very efficient, and this should be the basis for the vast majority of the wealth that you're saving and accumulating to achieve your financial goals and to support your family in the future. Okay, well, how do we do this? How do we actually go about building these efficient portfolio investments for our clients? Well, we're going to dig into the investing a little bit in the next couple of slides. We do it, we achieve these investment outcomes for our clients in an efficient way by applying what we call the 4 pillars of investment success. Okay, they are diversification, strategic rebalancing, low expenses, and tax deferral and tax minimization. I'm going to talk about each one of these with some detail here because this is really the bedrock of our investment approach that we apply on a day-to-day basis for our clients. Now, the first one is diversification, right? A sound investment portfolio is a portfolio that's diversified across a very broad range of liquid financial assets, assets that trade in heavy volume on the exchange, can be bought and sold with relatively or little or no cost. Okay, and these are the building blocks of an efficient portfolio. So when we work with a client and they provide money, they put money on deposit at the custodian where we work, and we start investing their proceeds, their investment funds. We build portfolios out of stocks, as you can see here, bonds, real estate, investment trusts, and commodities. And what you have in front of you then is a typical or a model portfolio. This is not a portfolio that we provide to any specific client, but it's a portfolio that's pretty representative of the types of portfolios that we do construct. It is true that for each individual client, we derive a unique and specialized portfolio as a result of a formal financial planning process, and will vary the different types of holdings depending upon different circumstances that apply to that family. But in general, most of our clients will have the majority of their assets invested in stocks and bonds, with some allocation to real estate investment trusts and commodities, as you can see laid out here. These are the different types of asset classes. These are the typical rates of return on these asset classes over long periods of time. And these are the expenses related to the funds, the exchange-traded funds that we use to construct these products. And to give you some sense of what kind of a rate of return and the kind of risk that you're taking on when you do this kind of investing, we've created this chart in front of you now. And what we did is we went back and we looked at all of the different types of assets that we have used here in this diversified portfolio. Okay, so U.S. stocks, international stocks, bonds, real estate investment trusts, and commodities. And we went back and we said, if we had owned this portfolio for the last 45 years, all the way back to 1972, and we had looked at the rates of return, the average annual rates of return for that portfolio for every 5-year period from 1972 up through 2009, 2009 being the last period because it's 2009 to 2014, what's the average rate of return over all those 5-year periods? And as you can see here, in no 5-year period did this portfolio ever generate a negative return. Okay, its worst year, 5-year period, was 1997, starting in 1997, which in the U.S. was the beginning of a great decline in U.S. stock rates of return because of the tech crisis. And then again, you can see it in 2008. We had the great financial crisis of 2008. But even in the 5 years starting in those 2 periods, the subsequent years were much better, bringing the average rates of return up to a very reasonable 4.5% rate of return. Now, of course, in other years we had much higher rates of return, well above 10, even 15% in some cases, so that the average rate of return for this moderate risk portfolio, as you can see here over this entire 45-year period, is 11.5%. Okay. Now, some people say, well, yes, but that doesn't tell us what's going to be in the future, and I'm much more pessimistic. Haven't you read what's going on with the Fed and in emerging markets? Well, what I say is, look, we never do know exactly what will happen in the future. But if you look back over this portfolio over the last 45 years, and you think of all the things that have happened in the world, and you think of all the exposures that this portfolio has, including exposure to emerging markets, to Europe, to gold, to oil, all of these things, every story that we may concern ourselves with going forward has happened. War, gold or oil spiking to $150 a barrel, oil collapsing to $10 a barrel, war in the Middle East, peace in the Middle East, extreme optimism about the U.S. economy, extreme pessimism about the U.S. economy. So we imagine a world in which the next 45 years, for lack of a better assumption, will probably look somewhat like the last 45 years. That is to say, it's going to be one with ups and downs, but a well-constructed portfolio designed with efficiently owned assets such as stocks and bonds will generate a very reasonable 9 or 10 or 11% rate of return. Okay, now, it's not enough just to build out that portfolio and sit on it. No, we have other ways we can add additional value to the portfolio, and this is our rebalancing strategy. Okay, what do we mean by rebalancing? Well, what we did here is we look at 5 high return asset classes. Okay, European stocks, emerging markets, commodities, U.S. stocks, Japanese stocks. And as you can see here, we looked at the rates of return on average annual rates of return over a 40-year period, 1970 to 2009. And what you notice here is the difference between the best and the worst wasn't much. They're all very close to the 10% average rate of return. However, if you break down the 40-year periods into 4 periods of 10 years apiece, you see a very different story. In any 10-year subperiod, you see wide dispersion of the rates of return. Okay? And what we can do by applying a strategic rebalancing program is we can play this, what we call the reversion to the mean phenomena that we see on a very regular basis, to essentially sell high and buy low. When parts of the portfolio have done extremely well over a a couple of years, they become outsized within the overall portfolio that we manage for the client, and other parts become underweight. Okay? From time to time, we will take part of the money off of the portfolio that's done extremely well, and we will buy what has not done well recently. And you can see with the reversion to this so-called 10% mean, you can see the logic of selling parts of the portfolio that have done recently, parts of the buying what hasn't done well recently, because over time they will tend to move back towards this long-term mean reversion. And this can have the effect of adding additional to our overall investment results. Now, what about low expenses? Okay, low expenses are a critical component of long-term investment success, because we know that aside from not investing at all, the two other huge biggest drags on real investment results that real investors receive are high expenses and taxes. So we spend a lot of time to provide investment outcomes that focus on keeping the fees and expenses related to investing very low. One of the key ways we do that is to use exchange-traded funds, which have a very low expense ratio. The typical portfolio that we will construct will have about 0.17% fund fee embedded in the funds that we use to build these portfolios. Now that compares to the average U.S. mutual fund, which has a 2.3% average investment expense. Now, it is important to put in the caveat here that, of course, in addition to the fund fees of the funds that we'll use, you have to pay a fee to financial advisors to manage your assets and provide financial planning and so forth. But that fee typically is about on the order of 1%. So even when you add that into the fund fees, the total cost of investing with Thune Financial Advisor still is on the order of typically half of what just the fees associated with a typical U.S. mutual fund will be. Okay. Now, I make a big deal about this because we know from all the studies out there, the academic studies that have looked at real investment returns, that this is a huge drag on actual investment outcomes for people. The biggest study showed that U.S. mutual funds generate a rate of return that underperforms their index or their benchmark by about 2.6% per annum for U.S. large cap stocks. So what we thought we'd do is we'd say, let's do a thought exercise where if you imagine that you have an opportunity in one case to simply buy an index fund like we would do for our clients and get the probable 9% rate of return you're likely to get with that over an extended period of time. And you make a one-time $100,000 investment using that methodology. Okay, after 20 years, that one-time $100,000 investment compounded at 9% a year for 20 years is going to be worth $560,000. The alternative you may have chosen was a mutual fund, a typical U.S. mutual fund. Okay. Now, let's say it's not an extraordinary fund, but not a bad fund. It's just an average U.S. mutual fund, which we saw from the previous slide is going to generate a rate of return probably about 2.6% below its benchmark. And again, remember the alternative index fund like we use will match the benchmark, not do better, but just match it. The result is over this 20-year period, the difference between getting 9% versus 6.4%, which is the 9% minus the average margin of underperformance for these types of funds, is going to result in $214,000 of foregone profit. Now, let's take that same thought exercise and just extend everything out over 40 years. Now we're compounding in the first case at the market rate of return over 40 years. Now we're left with more than $3 million. Alternatively, we could have compounded at the average mutual fund rate of return, and after 40 years compounding at a substantially lower rate, 6.4%, we're left with a little more than $1 million. That is to say, foregone profit of almost $2 million. Now the point of this slide and the point of this story is that, look, making an investment decision this year to go for a mutual fund that you thought looked like a good one, but it turns out not to be so good, or it turns out to just be an average mutual fund, versus just putting your money on the index fund is not going to have a huge impact on your wealth this year or next year. You know, your money's not going to disappear. It's not a huge catastrophe. But compounding these mistakes year in and year out over 10, 20, 30, 40, a lifetime of investing, as you can see here, will have a huge impact on your family's ability to generate wealth and achieve your financial goals. Now, the fourth pillar of investment success is tax deferral and tax minimization, right? Okay. We have to keep the tax man at bay by planning strategically our investment approach, as well as thinking about all the cross-border issues that come into play. And it's not just about the tax planning, but avoiding the big tax time bombs that will eventually create all kinds of problems and very expensive resolution. So what do we mean by that? Now we're going to kind of take this approach that we've laid out about how we invest and think about it in the context of this complex cross-border environment in which we operate. Okay, now the first thing I want to talk about is just the building out of a portfolio, like we've described in the previous slides, in a real-world scenario. So what we've got here is a spreadsheet that we maintain. It comes from a real client of ours. In this case, they're a husband and wife in the UK. And what you can see here is we've developed a model portfolio for them. Okay, and because they're in the UK and they intend to stay there, one of the things we're doing is we're investing in UK stocks and bonds, where maybe we wouldn't if they were retiring in California. But like many of our other clients, and like many of you, I'm sure, they have assets in brokerage accounts, IRA accounts, 529 college savings plans, they have a UK retirement account and so forth. Every one of these accounts has different tax characteristics. And every one of the types of investments we make, stocks versus bonds versus commodities, have different tax characteristics as well. So we need to think strategically about which investments are held in which accounts, because we're not going to recreate the entire model portfolio that you see over here on the left in all 6 of their accounts. It would be extremely cumbersome, but more importantly, it would be extremely inefficient. We want to think about which investments can be most tax efficiently owned in which accounts based upon tax considerations. So to give you an idea, although this gets really complex and we spend a lot of time on this with our clients, for example, we'll put some of our most aggressive investments in 529 and Roths because those are tax-free accounts. And when we look back on our investment portfolio in 20 years, we will imagine, whoa, we're very happy that we kept our best performing investments in the accounts where all the growth was tax-free. Alternatively, lower growth but higher current income investment items are going to be tax optimized if they're held not in tax-free but in the tax-deferred accounts, such as traditional IRAs, UK pensions, and so forth. And there's a lot more we could say on this, but this is a critical component of building long-term tax-efficient portfolios. Well, what about some of the cross-border issues when we have, as we discussed before, a mixed family? One citizen, one person is a U.S. person, a citizen, or maybe a long-term green card holder of the United States, married to a non-resident alien, right? You've left the United States, you acquired citizenship, or you became a permanent resident at that time, but you moved back home, and now you're living, and you've married someone who was never in the United States as a non-resident alien. She doesn't have or he doesn't have U.S. tax obligations. So you still want to think about your family as a family unit, and you still want to be able to approach the way you build your assets in a diversified way using cost-efficient options such as ETFs. Okay, but now you have to think about these complex issues related to the fact that one person is subject to U.S. income tax and U.S. estate tax, and one person isn't. Okay, now this can get really complex and there's lots of issues here. But to give you a couple of ideas, we've laid out a stylized example of this where we imagine a U.S. husband, U.S. taxable person, is in Hong Kong married to a Hong Kong wife, right? So the wife is not subject to U.S. taxation and critically not to U.S. estate tax, okay? Whereas the husband is. So when you think about that, we may decide that the Hong Kong wife wants to have a diversified portfolio, probably does in fact, but when we think about the fact that she's going to be subject to U.S. estate tax on her U.S. citizen assets, referring to the discussion provided by my colleague Stanton earlier, we're going to want to concentrate of a diversified portfolio all of the non-U.S. citizen assets in the wife's accounts and all the U.S. citizen assets in the husband's accounts, because he has this very large $5.5 million exemption on those assets, whereas the wife has only a $60,000 exemption on the U.S. citizen assets in her portion of the overall account. So we have to be very careful about thinking about who owns what. And there's a lot more we could say on this, but you get the idea. And there's a lot of iterations and complexities that we have to think through when we help families with mixed exposures to U.S. taxation and estate tax to build efficient portfolios so that they can achieve in an optimal way their long-term outcomes. Now, another point I want to hit on here is currency management, because we all live in a world where we're very focused on massive swings in the value of the U.S. dollar versus other currencies. Our approach here, which is very important, is not to ever be thinking about coming up with some formula to tell us what we think the dollar is going to be against the Hong Kong dollar or the Canadian dollar or the euro or the yen next year or even 2 years from now. That is just guessing. We don't know. What we do instead is we say, let's think about the things that we're building our wealth for, presumably retirement, saving for our children's college education, and thinking about what currency we have to pay for those things in. So what we've got here is a scenario. So for example, if you're going to be retiring back in your native country, Germany say, or France, then you're going to be building wealth now while you're in America to pay for a retirement that's going to be denominated in euros. So a much larger portion of your portfolio should be in euro-denominated investments rather than dollar-denominated investments. Now, you're still going to have a substantial allocation to dollar assets because they make a very large portion of the world financial base, and to have a properly diversified portfolio, you're always going to have some U.S. dollars. But you're going to have a lot less U.S. dollars in your investment portfolio or U.S. assets than if you were going to retire in California and have to pay for that retirement in U.S. dollars. Okay, so you can see here in this stylized portfolio, we've put about 44% of the portfolio assets in European stocks and bonds and a lower proportion in U.S. stocks and bonds. If you're going to retire in the U.S., you can imagine these proportions being relatively reversed. This way, we hedge ourselves against the biggest currency risk that affects us as long-term investors, that we save in one currency only to find out 30 or 40 years from now when we want to retire, or even 10 years from now, or 5 years from now, that we've been saving in one currency to pay for bills in the other currency, and the currencies have moved in the wrong way, and we can't afford to do what we plan to do. Okay, we hedge that by keeping ourselves properly exposed, by matching our savings with the things we're going to be saving for. Now, I'm going to wrap up here so we can get to the questions and answers, but I just want to now finally finish up by just going through a long laundry list of all the kinds of other issues that we haven't got time to get into, but maybe will come up in the discussion. And for example, when you're in this cross-border environment, especially from the point of view of being U.S. taxable, you have to understand what FATCA is. We discussed that before. You have to understand some of these common tax traps, the FBAR report, passive foreign investment companies, foreign trusts. We've discussed them already. You have to understand, if you move abroad, about the complex interaction of U.S. and local taxation. And this comes up often when we talk about the foreign earned income rules and what they imply for things like savings in an IRA and so forth. Self-employment tax, U.S. citizen spouses creates all kinds of complex cross-border planning issues, as we've already discussed. Bilateral tax treaties that the United States maintains with about 16 different countries around the world are very important to deal with these. So you have to understand the role that they play, totalization agreements, and other issues. And all of these things are the kinds of things we work on with our clients every single day. Because although, in the end of the day, they may need a lawyer to help them with their estate documents, they need a good financial advisor who's making the investment decisions that understands the complexity of the tax and legal and jurisdictional issues that they face. Okay, and that's our role. Now, finally, we're going to finish up here. I just want to give a couple more comments about how we operate. Our firm, Thun Financial Advisors, works primarily with Charles Schwab as a custodian for our clients. Okay. When we start working with the client, the first thing we do is create an individualized wealth management plan. We gather information about the client. We assess the client's financial situation, help them establish goals. Then we prepare a customized written plan. Okay, a financial plan. That includes all kinds of things, including an asset allocation model, which will guide the way we then invest their assets for them. Then subsequently, year in and year out, we monitor the plan, we adjust the plan, we make strategic rebalancing decisions in the portfolio, we make changes in the portfolio as necessary, and we continue to advise them on all of these broader financial issues we've been discussing. Collaboration, we work very closely with our clients' lawyers and accountants on these issues. And we try to be the clearinghouse for all of these issues. And we charge on the basis of assets under management. I'm going to show you our fee in just a second. And my last word is that integrity, trust, and confidentiality are operating codes of conduct. To do a good job for our clients, they have to trust us with a lot of critical information about their family, about their finances. We take that trust extremely seriously in terms of the way we provide confidentiality for the client, guard their information with our systems, our procedures, our technologies, and of course the very strict regulatory environment we work in. So I'm going to leave it there. You can see our fee schedule here, and I'm going to open it up. I'm going to ask Stan and Fred to join me, and we will unmute everyone so you can begin asking questions, although I see we've already got a bunch of questions.
I know I don't have to question this part.
So maybe we'll just, we'll ask everyone to, let's see if we can get some. Okay, so if you have a question now, please go ahead and type it in the chat box. I'm going to unmute everyone, which means everyone's going to be able to hear you. So if you've got a lot of background noise, if you could please let it, please cut it off. Okay. And now everyone should be able to hear.
It's different making a mistake and making
So feel free to speak up and ask a question.
That's one thing. I have a very low tolerance at the beginning. I don't have a problem because I try to remember how it was for me when I started. But I don't have a tolerance with someone that's going to lie to me about, we had someone doing my PhD, like, oh yeah, I came in, I changed this, and you know, like, don't lie to me about what you did, or, oh yeah, I was here, like, if you break my trust on this, and if I can trust you,
okay, so there we go.
What you're doing in the lab, that can ruin my career, and that's a big no.
So I think this is not going to work for everyone. You really want to get. Unfortunately, someone's carrying on a private conversation, and I don't want to disrupt that conversation. So I'm going to just ask people for now to type their questions. I don't know who she is.
Are rules different than?
Let's see. Okay,
There was a question. Yeah. There was a real question. Mario had. There we go.
Oh, I'm sorry. These the question. The most recent questions are up here. No.
Keep going. Keep going.
Okay, very good. Here's a question. Okay, great. Here's a question. Are rules different with people who have double nationality? Generally, no. The U.S., from the U.S. perspective, your taxation, if you are a U.S. person, remains absolutely the same, whether or not you may have citizenship of another country. Now, from the other country's perspective, it may make some difference in the sense that when you move to another country, or you maybe move back to another country, if you have citizenship already in that country, some of the exemptions that maybe a foreigner would receive, you will not be eligible for, right? You will become fully taxable immediately upon reentry to that country. Because remember, while you're in the United States, for the most part, if you're coming from another country, you are no longer taxable in the country from which you came, except for possibly on some income sourced in that country. And so when you are a citizen of a country that you return to, you don't have some of the benefits that foreigners have when they return to those countries. Aside from that, there's really not much. From the U.S. side, there's absolutely no difference whatsoever.
Good question.
Excellent question. Okay, here's a question. I plan to retire in Germany next year. If I have new income through employment, do I have to report this to the U.S. tax? I am a resident alien green card holder. Okay, very good question, comes up all the time. Stan or Fred, you want to explain the rules? It's pretty straightforward.
Go for it, Stan.
Is it 7 years?
7 years.
8 of 15.
Okay, yeah, if you have been a green card holder in 8 of the previous 15 years, then you are going to be considered a U.S. person, even if you leave the United States and move to another country, unless, of course, you go through the process of formally renouncing your green card status in the United States, which is somewhat akin to expatriation for a U.S. citizen. So it is something that you are going to want to have some advice about. It's something that you're going to want to strongly consider the pros and cons of renouncing your green card status.
Right. And I would add that it's not just simply giving up your green card, right? If you
Exactly.
have been here for more than 8 or 15 years, you can get rid of your green card, but you remain permanent. You still remain subject to taxation unless you go through the expatriation process. And the expatriation process itself can subject you to a large exit tax, depending upon your circumstances. So we'd love to talk to you more about that in more detail. Just feel free to contact us.
Another good question, huh?
Yeah, try muting it maybe now.
Okay. What about a resident alien on an H-1B visa? I believe, correct me if I'm wrong, as long as you are here on an H-1B visa, you are a resident and you are subject to worldwide taxation. However, you're not. You can once it expires, your status as a U.S. person ends, right? And therefore, you are not building up time towards this 8 of 15 years whereby you become a permanent resident of the United States and you can't get out of it without going through expatriation.
Yep.
Okay, if you are a U.S. citizen and you relocate to another country upon retirement, can you still receive Social Security benefits abroad? Yeah, good question. Absolutely. Where you live in the world has no impact on your eligibility and your right to receive Social Security. That is determined by your working history in the U.S. and your payment of Social Security taxes. And it is very common for Americans and non-Americans who've lived and worked in the United States, who've paid Social Security taxes and Medicare taxes, to benefit from, to receive their normal payments wherever they are in the world, and the Social Security is well known to deposit these checks anywhere in the world that you want them deposited to. So yes, absolutely, you're fully eligible for this if you are eligible by rule of having made the minimum contributions, which, by the way, you have to have worked here for 10 years approximately. Do you have a different fee schedule for advice-only clients? No, we do not. We don't have advice-only clients. We only work with clients whose assets we manage. That's a very common question. It's a good question. What we've learned is that it really is not what is really appropriate for the vast majority of our clientele. To the extent that you have sufficient assets that these planning issues become very serious matters, which is the case for our clientele and for the people who need this kind of planning, what we find is it's really very much of an ongoing process, and simply charging on a one-off for it is not ultimately going to be a good outcome for the client. Plans are made, recommendations are made, the plan goes in, a couple of the recommendations are made, issues are put off, decisions are put off, and very little of it gets implemented. 2-3 years passes, and now it's very stale. It's maybe even counterproductive. This is a process, wealth management and managing these issues, that is an ongoing, constant issue that you want us to be there managing on your behalf.
More questions?
Okay, more questions.
One above that as well.
If you sell a property abroad, are you taxed in the U.S. for capital gains? Fred?
Yes, if you lived in the property, if it was your, primary residence, you could take advantage of your, the IRS exclusion on that. But if you're in the U.S. and you sell, a house in France or something like that, you will, have to find the basis and have to calculate the tax owed in France and also in the U.S. And there are tax credits that could kind of minimize the burden of the taxes paid in the U.S. But it's a fully taxable asset and fully reportable transaction.
Right. So I think the key way to think about this is the U.S. doesn't care where the house is, right? It's no different if it's in France or California. It's taxable to a U.S. person in exactly the same way. Okay. If you're living in it, you're going to get a $250,000 exemption on the capital gains. And if it is in France, and if it might be subject to taxation in France, of course, you will get a credit for taxes paid in France. Okay, next question. If I want to take my retirement portfolio to Germany and want to buy a house, does it make sense to take a large chunk of money, $200,000 to buy the house? Can I take this amount out, or is it better to keep it in an annuity? Good question. The problem with making a large withdrawal from an annuity is that this is typically going to be a taxable distribution. And if you withdraw the money all at once to buy a house, whether it's in California or in Germany, the distribution from the annuity will probably be somewhat or completely taxable. So you have to look at the tax implications of the withdrawal. But whether or not the house that you're going to be buying is in Germany, or whether you're going to be in Germany or not, is really irrelevant, except maybe to the extent if you withdraw the money after you've already become resident in Germany and you're subject to taxation in Germany, then you may face an even higher tax burden in terms of the German tax treatment of that annuity distribution. Stan, is that correct?
That's absolutely correct. You're always going to want to think about these things in an after-tax mindset, right? I mean, what are the tax consequences of taking the distribution? Are there more tax-efficient ways for me to make this house acquisition? And really, every situation is somewhat unique. So we're obviously not giving you individualized advice on what you should do under this particular scenario. We'd want to know more about your situation before making that determination. But in general, you need to consider the tax consequences of that kind of distribution from an annuity for sure.
Okay. Next question. Are there any issues or saving advantages with dual national children who most likely will study in Europe? Well, Fred, you wrote a note on cross-border planning for expenses. You want to answer that?
So yeah, you could, opening up a 529 college savings account, while in the U.S. could, save you on your state income taxes. You could also, a big thing that people don't know about is that 529 funds can be used at a lot of international schools. Especially in Europe, many of the larger, institutions are qualified to receive 529 college savings funds. So you'd be able to take advantage of the tax-free growth in the 529 accounts, and you obviously use them in the United States, but also use them at a lot of foreign institutions as well. So it does make sense to save in a 529 account if your child might go to another school in another country.
Fred, what if we move abroad and we have our 529 accounts while we're living abroad? Are there any implications of that?
It typically too, owning, you can move abroad and continue to own 529 accounts. There might be some local country rules, but this is something that we widely recommend to a lot of people to, even while abroad, to contribute to 529 accounts.
I will say on that last point, it is somewhat important to address the local tax treatment of a 529 account. That can be, in some cases, a barrier to making it an effective approach to building wealth for your children's college education expenses. Okay. Next question. Is the taxable amount for the sale of the house abroad based on the difference between its value at the time of acquisition, e.g. from inheritance, and its value at the time it is sold. Well, if you receive the house in inheritance, then there's a different set of rules that apply. Stan, you want to talk about the U.S. rules on inheriting assets?
Yes. Under U.S. law, your basis your basis in a property, if it's inherited, will be the fair market value at the time of inheritance. So you did phrase this correctly by suggesting that it is the difference from the value that the item is sold at from the basis that, or a fair market value of that property at the time it was inherited under U.S. law. Now, that may not be the case in a foreign jurisdiction, but that is certainly the way that we assess tax on gains in the United States of inherited assets. Yes.
Right, and that just distinguishes it from the sale of a house when it's not been inherited. When it's not been inherited, you have to look at the difference between what you paid for the house and what you sold the house for. What you paid for the house is the basis, and in that circumstance, it could be a lot lower, which could imply substantial capital gains tax. There is a $250,000 exemption, but anything above that is going to be taxed. I mean, one thing we see quite commonly for many of our clients in London, where houses have always been expensive, but now we've had clients there who've been there for 5 and 10 years, and they have very large gains on the value of their primary residences. And the UK rules, for example, provide for no capital gains on the sale of a primary residence, but the US has only this $250,000 exemption. And lo and behold, they're getting a lot of the Americans there who go to sell their house upon returning to the United States are getting the nasty surprise of finding that they're going to owe a very substantial U.S. estate tax, even though they owe nothing in terms of UK estate tax. A UK capital gains tax on the sale of that UK house, as opposed to what it would be in the UK or what it is in the UK, which is zero.
Right. And of course, if you're gifted property, instead of the value at the time of inheritance, when it's a gift, you're going to effectively step into the shoes of the donor. So the basis that what the donor acquired the property for is going to be against which the gain when you sell is evaluated. So inheritance can be, on an appreciating asset, can be much favorable over gifting strategies. Important point to remember.
Yes, absolutely. All right, no more questions now. If any of you would prefer to speak your questions, I'm going to try to unmute everyone again, and as long as we don't have a lot of background noise, maybe you can just speak up, and with additional questions or follow-ups, feel free. We'll give it a minute or two. Okay, I'm going to give it just one more minute, either type or ask a question. If you are interested in speaking a question, otherwise we're going to wrap it up. All right, great. Well, I'm glad we had a good discussion at the end. Thank you all for joining and attending, and thank you for your good questions. Again, feel free to contact Tune Financial Advisors. We'd love to talk to you in more detail about your particular circumstances and talk about the many ways in which we can work with you to effectively build wealth. We are here, and feel free to contact us. We'll be sending through an email. You're happy to respond to that. And again, as I said in the beginning, watch for our future presentations, and if you thought this was useful for you, please don't hesitate to recommend these presentations to other colleagues of yours, other Americans abroad or foreigners living in the United States, green card holders, and et cetera, who might be interested in all the complex issues we've talked about here today. Thank you so much.
Thank you. Thank you.